The Nifty 50 was up 2.06% in July. IT stocks up 19% in a single month. Foreign selling down to just rupees 6,056 crore. So what should investors do next? If you are a mutual fund investor or someone wondering whether to put fresh money into the market right now, this video is for you. Stay till the end for our 5 model portfolios. I am Pooja and with me is Vishal. Vishal, July looks like the month FII selling finally stopped mattering.
That's the story, Pooja. Look at the flow numbers. FII outflows peaked in March at Rs 1.22 lakh crore. Domestic institutions bought Rs 1.42 lakh crore in the same month and absorbed all of it. Since then, foreign selling has faded every month, down to Rs 6,056 crore in July. When that supply pressure lifts, large caps move first because that's where foreign money sits.
Which shows up in the index numbers. The Nifty 50 TRI led with 2.06%, the Nifty 100 TRI 1.98%, then it tapers. Nifty 500 TRI 1.7%, large mid-cap 250 at 1.61%, next 50 at 1.6%, mid-cap 150 gained 1.25%, small cap 250 managed 0.83%. The further down the size curve you went, the less you made.
That's the reverse of June, a large cap-led month.
The sector table is even more lopsided. Vishal, walk us through it.
IT gained 19% in July, the biggest single sector move we have seen in a long time. And it came off a weak base. Consumer durables followed at 10.7%, reality 8.8%, media and auto both 7.2%, pharma added 4.2%, and FMCG 1.9%. Financials and energy sat out. Energy fell 3.6%, defense 3.4%, PSU banks 1.9%, private banks 1.4%, technology and consumption carried the month.
After a run like that, are we getting expensive? That's the question viewers ask every month.
Not on this data, Pooja. The Nifty 50's forward PE moved between 18.4 and 19.5 times through June and July, and closed the month at 18.7 times. The 3-year average is 20.4 times. The index is trading at a discount to its own history even after the rally.
Let me take the global picture because crude oil is the headline. Brent dropped to $69 to $72 in early July when US-Iran tensions cooled, then went straight back to $88 to $90 by month end. US inflation improved with CPI at 3.5% in June against 4.2% in May, and monthly prices falling 0.4%. The Fed still held rates at 3.5 to 3.75% for a fifth straight meeting and kept its hawkish tone. The US 10-year Treasury is above 4.6% and Japan's 10-year yield is at multi-decade heights. Vishal, what does $88 crude oil do to India?
It's one of the main risks. Higher crude oil raises the import bill, feeds inflation, and pressures the rupee. The rupee ended July at a record low of 95.73 to the dollar. However, the RBI's FCNR deposit measures could bring in $50 to $60 billion of capital inflows, which helps on the currency side.
There was better news on trade, wasn't there?
Yes, two things. The India-UK CATA took effect on 15th of July and gives zero duty access for nearly 99% of Indian exports. And India signed over 100 plus agreements with Japan, with planned Japanese investment of about Rs 1.2 lakh crore. On the US side, the proposal keeps Indian pharma imports tariff-free until August 2028, then 100% and 200% from August 2029. That hangs over pharma exporters, though they keep a cost advantage and have time to shift volumes towards BRICS countries, Africa, and West Asia.
On growth, the IMF trimmed India's FY27 forecast to 6.4% from 6.5%, citing crude oil and monsoon risk. It raised the FY28 number to 6.7%.
A small trim this year and a higher one next year. The medium-term view holds.
On to prices, retail inflation rose to 4.38% in June from 3.93%, with food at 5.32%. Rural inflation at 4.74% is running above urban at 3.92%, still under the RBI's 6% upper limit, and the Q1 FY27 average of 3.9% came in below the RBI's own 4.2% projection. The wholesale number is the uncomfortable one. WPI hit 9.87% in June from 9.68%, with fuel and power inflation at 27.41%.
That's crude oil showing up in input costs. Industrial production was the bright spot, with IIP at 7.3% in June against 5.1% the month before.
And the internals were broad. Manufacturing rose 7.8%, with 19 of 23 industry groups positive, and capital goods grew 14.2%. Bond markets were quiet by comparison. The 10-year G-Sec ended at 6.8% on 29 July, up 3 basis points from a month earlier, after trading in a 6.68 to 6.86 band. Call rates eased to 5.3%. The curve flattened a little, with yields on 2 to 4-year paper rising 20 to 40 basis points, while the long end held near 6.8%.
Which tells you markets have priced in higher near-term rates and long-term inflation expectations stay anchored.
So putting it together, what's our investment strategy for the month?
4 points. We prefer mid-caps and small caps, followed by large caps. Invest in a staggered way through SIPs or tranches. Keep gold as a strategic hedge and build some global allocation through Gift City outbound offerings.
And debt?
Yields are expected to stay range bound, so accrual-oriented strategies and shorter duration funds remain the preference. Those earn the coupon without a big interest bet. A measured gold allocation applies here too.
Now the part viewers wait for, the model portfolios.
These are the views for different risk profiles, not recommendations. The aggressive basket runs 20% large cap, 40% mid cap, 25% small cap, 5% flexi cap, 5% thematic, and 5% gift outbound. The moderate basket holds 20% large cap, 22% mid cap, 10% small cap, 15% balance advantage, 23% corporate bond and short duration, 5% gold, and 5% gift outbound. Conservative is 70% corporate bond and short duration, 20% balance advantage fund, 10% gold.
And the two special baskets?
Regular income for lump sum investors who want steady income holds 70% balance advantage and 30% multi-asset. Build India for higher risk investors backing the domestic growth theme holds 80% thematic and sectoral funds and 20% flexi cap and multi cap. Scheme names and riskometers for every basket are in the full report, so read it along this.
Last question. What breaks this setup, Vishal?
Crude oil staying at $90. Add an escalation in West Asia, an inflation surprise, or a sharp reversal in FII flows, and volatility comes back. The monsoon matters too. A strengthening El Nino in the second half of the season would push prices up and hit rural demand.
To sum up, this was a large cap led July, with IT leading the sectors, valuations below the 3-year average, foreign selling close to done, and crude oil as the risk to watch. We'd love to hear your view as well. Which part of the market are you most bullish on right now? Large caps, mid caps, small caps, or IT? Let us know in the comments below. Happy investing with Mirae Asset Sharekhan.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.